It is record low interest rates, so 1% domestically and even lower abroad. We've got negative bond yields in Europe, so this is sort of unprecedented territory. I was an advisor, I remember the 8.8% term deposits from Macquarie Bank at the Beijing Olympics in 2008. It seems amazing that you can get term deposits that high these days, but that's what they were. So I think largely it's a function of the fact that we had the GFC. Really for the first time in history, central banks and governments intervened to the extent that they did with quantitative easing, which is essentially making money as cheap as possible. That led to a period of rapidly declining rates to where we are now. Also, the level of indebtedness that was essentially transferred from banks and other institutions into sovereign debt has meant that we've had to stay there. That now I think it's well known now that a 1% increase in interest rates is probably equivalent to a 5% increase back in the 80s and 90s. So, I think low rates are here to stay. Obviously, property's had a stellar run over decades. You would argue that the number one reason for that has been a structural decline in interest rates. The real issue we have, and particularly domestically, is the high level of household debt, currently sitting at 190% of income. So just that in itself means that we're constrained as to how far rates can rise. This is where I guess having an advisor makes a lot of sense. They can cut through the noise. We do think that the next probably 12 months is going to create a lot of headlines, noise. And that's when getting a sort of sounding board can be really valuable. In terms of producing income, again, I think, unfortunately the sort of conversation you're going to say is that we're going to have to get used to a little bit lower income than what we've probably been used to in the past. But when we look at different asset classes, the risk premiums, which is essentially the extra return we're expecting to get for the risk that you're taking on for equities and property and everything, still appear to be there. Whilst everything has sort of come down a notch, the reward's still there to go into riskier assets like property and shares. Again, you retreat to cash, I'll say it again, you're going to get 1 or 2 for as far as the eye can see. And that's probably not going to give you the investment experience you need. Short term, I think, brace for a bit of volatility. I think that's probably fair to say. Again, it's really good if you've prepared your portfolio for that volatility. Asset allocation methodology, the buckets that are talked about with clients, does really help manage that risk very well. But certainly we could be entering, a period where market prices do decline, and that's normal, for risky assets. Once every 4 or 5 years is pretty normal. The bold investors actually take it as an opportunity, but for most people it's about staying the course. Again, talking to your advisor, they're going to be the steady ship that helps you stay on course. I think that's an important thing.